right? It's a long-term debt. So this is the liability sides of the gap incorporation. So you see current liabilities first. You write it down on liquidity basis. Who's due first? Current maturity of long-term debts, accounts payable, accrued expenses, income tax payable, right? So see, prepaid expenses are your assets, accrued expenses are your liabilities. Prepaid, you paid it in advance, expense didn't happen. It means it still have some economic value. Expense didn't happen. It still have some economic value. So that's why it's your asset. Accrued expense, expense occurred, you didn't pay. Outsiders claim. That is your liability. Understand? So these are just small concepts. If you understand that one, there's no problem for you to do some kind of examples and assignments. Okay, long-term liability, long-term debt here, maybe bank loan or something. Other long-term liabilities, total long-term liabilities, see. So total liabilities, which is the sum of long-term liabilities plus current liabilities. So you can also compare from 2012 to 2011. What is the new year? 2012. What is the old year? 2012. So your liabilities are increased. It is good for you or bad for you? Anyone? Your total liabilities are increased this year in 2012. It is good or it is bad?
Bad.
We don't know until we have some new information, right? Loan is always not bad. Sometimes it is good, sometimes it is very bad. For that one, in order to answer the question, you must have something to compare. If you compare on your previous year, then this is bad. If you compare with the industry, maybe in industry, your compatible is having $5,900 million of total liability. So you are still safe because you can say that we are safe, we are good. We have a less liability. So remember, whenever the question says it is good or bad, so you need to see the parameters. Good or bad based on what? From its past, from its competitors' point of view, or from industry point of view. Right? Good. Now, stockholders' equity or owner's equity. So which represents the ownership of the business. So it includes common stock, additional paid-in capital, retained earning, treasury stock, and OCI, which is other comprehensive income. Right? Common stock and paid-in capital. Additional paid-in capital, we call this paid-in capital. So paid-in capital has two parts, common stock and additional paid-in capital. We'll talk about this when we talk about shareholders' equity. So just remember that one. Owner's equity, in our previous slides, we talk about paid-in capital plus retained earning. But now, paid-in capital has two, which is common stock and additional paid-in capital or premium on paid-in capital. Different books have different names. Retained earnings, treasury stock. What does it mean? Okay, first of all, common stock, it means amount represents the par value of the share issued to the stock. If the company issued the stock in the market worth $10, we call this common stock. But you can see on the stock exchange, the value is $10 of one stock, but it is traded as $233. Right? Right? So it means common stock is for $10 and additional $223 is additional paid-in capital. Sorry, 223. Yes, 23. The original value of one stock is $10, but it is trading in the market as 233. It means On the top of that, you are above $223. So the additional paid-in capital. Retained earnings, I already told you, I'm not going to explain here. Treasury stock. If company purchase its own stock from the market, its own stock, we call this treasury stock. If company purchase other company stock, it is called short-term investment or long-term investment, depending on the goal, whether you hold it for less than 1 year or more than 1 year. But if company repurchase its own stock from the market, we call this treasury stock. And then other comprehensive income, I'm just going to give you a small idea because this is advanced level. This is a small idea. For example, Apple Corporation is based on California, US, right? But it is operating in China. So when Chinese Apple company who earned 100 billion Chinese yuan profit and send this to US, its parent company, company said we will receive, for example, $10 billion. But due to exchange rate, when Chinese Apple company send 100 billion yuan, and due to exchange rate, what happened? The US company was expected to receive $10 billion, but it received 11 billion. So $1 billion increase. Did company did anything extra effort? Took any risk? Nothing. It out of nowhere, company received more $1 billion. We call this other comprehensive income due to foreign currency translation. When you convert from one currency to another currency, sometimes you have a profit, sometimes you have a loss. Or company expected to receive 10 billion but received 9 billion. $1 billion is lost due to exchange rate. So manager will say that this is not our, this shouldn't be on our performance, lack of our performance. Why? Because you gave us target of 10 billion yuan, 100 billion yuan, we earn 100 billion yuan. But when we remit this 100 billion yuan to the parent company, we have a loss, which is we cannot control the foreign exchange market. So we should not be given punishment on that one, right? Other comprehensive income or loss. Right, guys? So that's a little bit advanced one. So we will not discuss here. We will discuss it in our advanced accounting. So don't worry about here. Just giving you the idea here. Additional paid-in capital, yeah, amount received, initial sale of company stock, excess of par value, retained earning, I already explained, portion of net income reinvested into the business, treasury stock, amount paid by the company to repurchase its own stock, and items of gain or loss that are allowed by Financial Accounting Standard Board to bypass income statement to be recorded directly to the stockholder equity. I just give you the example here. Other comprehensive income, it's like foreign currency translation and it's like that. So this is the equity side of the balance sheet of GAAP Incorporation. You see here, common stock, additional paid-in capital, retained earnings, accumulated OCI or accumulated other comprehensive income. You have a treasury stock, or this is total equity. So you added total liabilities plus total equity. Answer would be 7422. So look at that. 7422 must be our total assets of GAAP Incorporation. Total assets of GAAP Incorporation. Do we have GAAP? 7422 total assets, right? Asset side. Our balance sheet is balanced. So look at the name, balanced sheet. Balance sheet. So equation is balance. Understand? Any question? Let's move forward. Now, our third Fourth financial statement is statement of cash flow or cash flow statement. So what we have done up till now, first we make income statement. From income statement, we find out net income. And then we make retained earnings. For retained earnings, we will use net income from income statement. We add it to our beginning year retained earning, and we less the current year dividend, and we find out ending retained earning. For ending retained earning, we add it to our balance sheet. We make balance sheet statement. The third number is for balance sheet. Fourth number of financial statement is cash flow statement. And cash flow statement shows what happened to the cash position during the year. What happened to the company's performance would be measured through income statement. What happened to the cash position, we will measure it through cash flow statement. And cash flow statement formula is cash flow from operation plus cash flow from investment plus cash flow from financing. So cash flow statement reported three types of activities: operating activities, investing activities, financing activities. Operating activities, like I told you, buying and selling. Selling to customers, buying from suppliers. Investing, like you are selling or purchasing long-term assets. You are purchasing furnitures, laptops, ACs, plants, equipment. You are selling old plants, selling old furnitures, old mobile phone, old vehicles, old cars, old trucks. These are investing activities. So these are not your routine business. Your routine business should be written in operating activities. Financing, how you are going to finance, how finance is going to be arranged. Either this finance is going to be arranged from outsiders or insiders. So anything you borrow from your creditors or from outsiders would be written under financing activities. Or anything you repay to the borrowers will be written here. Borrowing will be positive, repaying would be negative. Why? Because when you borrow, cash is coming into the business. When you repay, cash is going out from the business. So that's why it's a negative cash outflow. Borrowings, cash is coming to the business. So it is a positive. Similarly, financing also be coming through honors, through equity transactions, like issue stocks. When you issue stocks, cash is coming to the business. People pay you money and you issue stocks, shares. But when you're paying dividend, it's a negative sign, cash outflow. Similarly, repurchase of company stock is also outflow, negative. Understand? So whenever you are making the cash flow statement, think in terms of business. Is cash is coming to the business, it's a positive sign. It's cash is going out from the business, it's a negative sign, cash outflow.